Randy Sullivan.
Sorry.
Good afternoon. I'm Randy Sullivan of Patton Sullivan Brodell. I'm on the board for the real estate section. I want to give a quick plug for next month's program. It's April 28th. We'll have a program on partition and new developments under the heir buyout right statute. And we have speakers that'll be covering partition and from the perspective of civil litigation, family law, and probate law. And so now I'd like to turn it over to our speakers and thank them for their time today. We have Mary Cunningham and Teresa Fluegel from Chicago Deferred Exchange. I'm sure they've seen just about every type of creative exchange our clients can come up with and can also fill us in on latest developments, maybe with the, as we were covering a little earlier, with the demand in the market. And so thanks again for your time.
Thank you, Randy. Thank you, Anne. Hopefully everybody can see our slide deck, and we're going to be presenting to you today on Internal Revenue Code Section 1031 tax deferred exchanges. We look forward to being here. My name is Teresa Fluegel. I've been with Chicago Deferred Exchange Company for 22 years. I'm local here in East Bay, and Mary Cunningham is joining us today from our headquarters office in Chicago. And she's been with Chicago Deferred CDEC over 30 years. We've worked together as a team. We, work on transactions all across the country. So we're looking forward to presenting to you today. And please feel free to put questions in the chat. We love to interact with the audience and make it an enjoyable educational presentation for you. So what we're going to be talking about today is recent developments in our industry, forward exchange mechanics, the role of the qualified intermediary, reverse exchange mechanics, improvement exchanges, common questions, critical timelines, boot, partnership issues, and other facts that have to do with 1031 exchanges. So Mary, would you like to take it from here?
Sure, and good afternoon. Thanks for having us. I thought I would just dive right into some of the potential legislative changes that the Biden administration had proposed to make to Section 1031. Back in May of 2021, the president put out his 2022 budget, and as part of the budget, they proposed to cap the amount of tax that could be deferred using a like-kind exchange to $500,000 per taxpayer per year, or $1 million for a married couple filing jointly. This alarmed us quite a bit because we were still sort of in the throes of the pandemic and commercial real estate was hurting, and we were concerned that a cap of any sort would hinder the recovery of commercial real estate and also potentially open the door to, at some point in the future, repealing 1031 in its entirety. So we, through our trade association and other real estate focused trade associations, spent a lot of time meeting with legislators via Zoom calls and helping them understand how critical 1031 is to economic activity, as well as a fantastic job creator. When the House Ways and Means Committee issued their markup of a potential bill in September of last year, there were no proposed modifications to 1031, which we found or thought to be a great victory. We were happy about that. And then we were watching pretty closely the path of the Build Back Better legislation, which now appears to be dead. However, we do know that the Democrats are still talking about introducing legislation via the budget reconciliation process, piecemeal legislation that may look like parts of the Build Back Better proposed legislation. So we are kind of keeping our eye on what's happening in that regard. 1031 has been in the crosshairs of potential modification through government for the last almost 15 years, honestly. In the lead up to this recent proposed modification, the Tax Cuts and Jobs Act did also modify 1031 a little bit, and I'll tell you a little bit about more of that a little more about that in just a second. There are a couple of things you can look at if you're interested in what we were talking to Congress about as far as the benefits of 1031. There's a macroeconomic study that was commissioned by a group of trade associations, real estate trade associations, that was conducted by Ernst & Young. What they found was that repealing 1031 would lead to a decrease in gross domestic product in the amount of between 11 and 17 billion dollars a year, every year, year over year in the long term. And then there's a microeconomic study that was performed by or conducted by two professors where they looked at over 1 million commercial real estate transactions over a period of 4 or 5 years and concluded that modifying or repealing 1031 would have, not surprisingly, a detrimental effect on commercial real estate and result in increased rents, more highly leveraged properties, which introduces more risk into this financial system. And it's really good reading if you have insomnia or if you're interested in these kinds of things. There is also an issues website that we have put up through our trade association. It's 1031buildsamerica.org. You can find those studies there, download them. You can also go to 1031.org, which is our trade association, to read more about what's happening. All right, so as I just mentioned a second ago, the Tax Cuts and Jobs Act of 2017 did modify the statute under Section 1031 to eliminate the ability of an investor to exchange anything other than commercial real estate that's held for investment or for use in a trade or business. So prior to the TCJA, you could exchange collectible assets, capital assets, certain intangible assets like FCC licenses. That the modification here in 2017 just says that basically you can only exchange real property that's held for investment or for use in a trade or business. No longer can you exchange your Picasso, Teresa, or your collectible car, collectible rugs.
Racehorse.
No airplanes.
No airplanes.
No more airplanes. So we were okay with that. We felt that that was okay. We felt that real estate was probably safe. We were wrong.
Yeah.
But for now it is. For now it is. So here's what the statute now says: no gain or loss will be recognized on the exchange of any real property held for productive use in a trade or business or for investment, as long as you acquire what's deemed to be like-kind real property also held for productive use in a trade or business or for investment. What doesn't qualify, and which has really never qualified under 1031, is any real property that's held primarily for sale. Inventory or property held for sale to customers in the ordinary course of your business.
So a lot of times people, there's different ways that people benefit from doing a 1031 tax deferred exchange. And 1031 has been around since 1921. So it's been definitely, 100 years. And, the number one is, tax deferral. I don't want to pay all the capital gains tax on the sale of my investment property. We have a couple of different examples about what that looks like. Folks like to diversify their real estate portfolio. They may be looking for increased cash flow, pride of ownership, appreciation. They may want to diversify and sell multiple and go into one, or one and go into multiple. They may want to do some development, better location, pride of ownership, owner users. And then at the end of the day, it's estate planning, because hopefully when their heirs inherit the property, they'll get a full stepped up in the basis at that time. And so it's a great diversification tool for clients. There's a lot of different nuances, a lot of black and white, and a lot of gray area, of which we'll talk a little bit more about. Cost of not exchanging. This is just an example that we have. If you're an investor and you're selling, and you purchased investment property for $1 million as an example, and you had depreciation of 100,000, you've done some capital improvements of 50,000, and today you're selling the property for 2 million. So you paid $1 million, you're selling for 2 million, and you apply, you take your purchase price and you deduct your depreciation, add in your capital improvements, and you give your adjusted basis. And in this example, it's $950. So, at Chicago Deferred Exchange Company, we do not provide specific tax or legal advice to our clients. We walk them, through the process. And this is just an example kind of demonstrating, what that would look like. So typically clients, they go to their CPA can give them an exact number as to what their potential gain may look like if they're considering doing an exchange. So once you apply the tax rates, you have depreciation recapture tax of 25%, federal capital gains tax of 20%, California state tax of 3.3%, plus the Affordable Health Care Act tax of 3.8%. So at the end of the day, the investor that paid $1 million selling for $2 million is going to be paying about $400,000 $100,000 in tax. And they're like, wait a minute, what are my options here? And the options are you either pay the capital gains tax when you sell the investment property, or you do a 1031 tax deferred exchange.
So Starker, you all know what the Starker cases were. They were a series of cases that came out of the West Coast, the Ninth Circuit in the mid to 1970s. Starker was really the first taxpayer to test the idea of the delayed exchange, where there is a delay between the disposition and the purchase of the replacement property. So what Starker did was he sold some property to a corporate entity, and in lieu of receiving cash for his property, he simply asked his buyer to acquire and transfer to him multiple replacement properties that he identified over. He had the ability to identify and acquire them over a 5-year period, but I think he actually completed his exchange within about 3 years. The IRS originally said that was not a good exchange because it was not a simultaneous exchange. They were of the view that you had to do the transaction at the same time, sell and buy property at the same time. The tax court disagreed and said you could exchange property today for a promise to deliver like-kind property in the future. And the '84 Tax Reform Act came in and imposed what we now know as these very stringent 45-day identification rule and 180-day exchange period rule. So you have to actually buy your replacement property within 180 days.
So our role, we do two things. We're very transactional. Mary's very transactional. She works on transactions all across the country, large institutional REITs, all the way down commercial hotels, mom and pops. The rules and regulations that we talk about are the same. If you're selling property for 100,000 or you're selling property for 100 million or 500 million, you're going to be subject to what these rules and requirements are, including the 45 days and 180 days that Mary just mentioned. And we'll talk a little bit more about that as the transaction unfolds. So our role is a third-party qualified intermediary. We're the third party, not the taxpayer, not a disqualified person who acts to facilitate the deferred exchange on behalf of the taxpayer under Internal Revenue Code Section 1031. We need to be involved prior to the close of escrow. So we're either going to engage, with the seller, investor of the property, their counsel, it may be their broker, but we definitely have to be involved so they don't have constructive receipt of the funds. So we do two things. We're either the qualified intermediary or we are the exchange accommodation title holder, the EAT, for a reverse exchange / parking arrangement. So we're either going to be helping clients when they're selling property and then purchasing property, or if they're in a situation where they need to purchase property before they can sell their existing property, which is a reverse exchange. Or they may do a forward improvement exchange. We have all different kinds of different options we can kind of talk about as we go through the presentation. We are headquartered in Chicago. We have offices in New York. I'm here in the Bay Area. We have an office in San Diego. We've been in business over 30 years. Our core team has been together 15 to 30 years. We have a lot of expertise, a lot of experience. There's probably not too much that's came across Mary's desk that, there's not too much that's going to come across that she has not seen or had experience with. We're owned by Wintrust Financial Corporation, which is a $50 billion financial services company in Chicago. So that's our parent company. That's who we are. So we're happy to be here today, and we're going to go a little bit more into the mechanics, and feel free to put questions in the chat. Basically, there's 3 general statutory requirements that we have to follow as the intermediary. The properties must be held for business or investment use, like kind to one another, distinguished from an exchange followed by a sale followed by a purchase. So when we look at those a little bit closer, property must be held for investment or for use in a trade or business in which the taxpayer is engaged. Business use property may be exchanged for investment property. How does a taxpayer establish investment or business use intent? So this is one of the biggest things that comes up with 1031 exchanges. How long do you have to hold property before you can sell it again? How long do you have to hold it to establish that, the intent was holding it for investment purposes for some period of time? Well, how long is that period of time before I can sell it or move into it? So it's one of the biggest gray areas that we have with 1031. And, you're going to look at facts and circumstances, and you're also going to consider your clients or the seller's risk tolerance and the risk tolerance of their advisor or their CPA. So middle of the road is a year is what we understand. Going over 2 tax years we know is good. There's a 2-year holding period for related parties. Anything less of that, the red flag kind of goes up and says, well, you should talk to your CPA to make sure you're on the same page. that it's a good idea that you've held it long enough that it's going to qualify for treatment of 1031 tax deferral. So we have an example that Mary's going to share with us about length of time properties held.
Yes, it's a real life example, a transaction we worked on last summer where a real estate investor sold some property in August and completed his exchange in November. And then early in the next tax year, he called us wanting to do another exchange on that newly acquired replacement property. So we had a conversation about what happened, why was he selling the property? Was he aware of this language that the property has to be held for investment or for use in a trade or business? We don't really know exactly what that means, as Teresa said. But we do know that his actions need to evidence his intention to hold for investment. He told us he got an offer from an adjacent property owner at a great premium to what he had just paid. He didn't want to pass it up. So he wanted to sell the newly acquired property and do another like-kind exchange. He did speak to his accountant about the transaction because, of course, the accountant has to sign the tax return. And his accountant determined that based on his pattern of activity relative to his own portfolio of properties, that he was not the kind of investor who was buying and flipping properties in a short window of time. He was really a long-term hold kind of investor. So they felt comfortable proceeding with the exchange even after he'd only held the property for that very short window of time.
We just opened another exchange for him yesterday, Mary.
Nice.
I think he held it for a little while though.
Here's a couple other things that we do look at occasionally when we're talking about this. How do you show what does held for investment mean? This 1984 private letter ruling said 2 years of business or investment use was sufficient to meet the requirement. Of course, it's a PLR, you can't rely on it. It's also pretty old, but it's out there. And the Neil Baker case is a really interesting case in property held primarily for sale. Mr. Baker was both a real estate developer and a real estate investor. He sold some vacant lots that he had owned for 11 years and tried to do a like-kind exchange. The IRS and the tax court both concluded that the exchange was not valid because he was holding the lots primarily for sale for that entire period of time. And part of it turned on the way he was categorizing the lots on his financial statements. They were coded as a work in progress. So it looked like they were actually being held for sale. So holding period is really only one factor you want to think about. It is not dispositive. Look at what your client's doing with the property. Look at how their actions evidence their intent.
Like kind, you can exchange any type of investment property anywhere in the US as long as it's held for investment. So basically anything that's not your primary residence that you live in, that's vacant land, it doesn't have to produce income. Vacant land qualifies. Multifamily, apartments, single family, shopping centers, strip centers, tenancy in common interest where you own property with another investor, industrial, retail, office, timberland, single tenant properties, triple net properties like your Walgreens, your Jack in the Box, CVS stores, beneficial interest in a Delaware statutory trust, a DST, very popular last year, and then existing leasehold interest with 30 years or more to run. You cannot exchange it to a brand new lease. So you can exchange anywhere in the US, any one of these properties, and oftentimes investors may not know that they can change, the different type of real estate that they have for investment. We typically see people that have single family go into multifamily. Multifamily users a lot of times will go into triple net properties, and owner users exchange for a larger or smaller building that they may want to have to run their business out of.
So the exchange requirement is really where the tax fiction takes place. What we want to do is make the transaction look like an exchange of one property for another and not a sale followed by a purchase. And what is critical in satisfying the IRS in this regard is that the taxpayer seller can never actually or constructively receive the proceeds from the sale of their old property. If they do, they will have a taxable sale and not a valid exchange. And there are two cases that we like to look at that highlight this idea of constructive receipt and then actual receipt. Crandall and Doolin involved a deal where two investors sold some property. They did not have any kind of exchange documentation in place. They simply asked their title company to hold on to their proceeds until they authorized the release of the cash 6 weeks after their closing. What the IRS concluded was that as soon as that relinquished property was closed, even though they didn't take actual possession of the cash, they had the constructive right to draw that cash right out of that closing escrow. And so they had a taxable sale and not an exchange, despite their best efforts. In the Peter Morton case, the taxpayer sold an airplane. He did have the right kind of documentation in place. He hired an intermediary. He gave the closing company instructions to wire the funds to the intermediary, but there was a mistake made at closing. And instead of wiring the funds to the QI, the funds went directly to the taxpayer's account. So he had actual receipt of his proceeds. Once the error was discovered, they wired the money back to the closing escrow and then sent the funds on to the intermediary. And he was successful in arguing that it was evidenced by the documentation, his intention was to exchange the asset, and he shouldn't be penalized for the error of the closing agent. So even though he had actual receipt, he was able to overcome that.
So structuring a forward exchange, once the client decides that they want to engage in doing a 1031 tax deferred exchange, we get involved to coordinate exchange documents prior to the close of escrow. So we have documents that's the exchange agreement between the client and us as a qualified intermediary. And then you can either use a trust agreement, an escrow agreement, a bank account agreement with a trustee or an escrowee depository institution under the safe harbors for Section 1031. And there's also an assignment of the taxpayer's rights under the purchase and sale agreement to the QI. So if we just step back to number 2 for a moment, our industry is really pretty low regulated. There's not a lot of regulation. Investors really need to be conscientious of where they are parking their exchange proceeds and who has them. What we've done, for over 30 years is we've taken that safe harbor language and we have gone above and beyond, and we create a separate qualified trust account for every client, every transaction. It does not sit on our balance sheet, does not sit on the balance sheet at the bank. So the client's funds are completely isolated and protected in their own trust, which is meaningful to our clients that we've worked with for many years. They know that about us and understand that, but it's just, you should always do a little bit of due diligence on the qualified intermediary industry, because not all qualified intermediaries are created equal. That's all I'm going to say about that. But this is kind of, that second document is, there's the exchange agreement, and then you will see the separate trust agreement, and then there's the assignment. And so we're tasked with acquiring and transferring the relinquished property from the taxpayer to the third party purchaser, and then the taxpayer assigns its rights under the PSA contract to us as a qualified intermediary with the notice of assignment in writing to the other parties to the agreement. So we have a couple of flow charts to show what that looks like in just a second. There's a technical advice memorandum out there from 2001 that states failure to comply with the safe harbor requirement that the QI acquires and transfers the property results in a disqualification. So if the client doesn't use a qualified intermediary, they're not going to have a successful exchange. This is what the transfer of the relinquished property looks like in our flow chart. So you have the seller, the taxpayer, legal notice and written notice of the assignment goes to the purchaser. There's a contract assignment between us and the seller, and then the proceeds of the sale are wired to us at the close of escrow. If the proceeds go to the taxpayer, to the seller, that's constructive receipt of funds, which Mary mentioned earlier, and they could not do an exchange. So we certainly don't want to get a phone call, this week that they closed last week, because it would unfortunately be too late for them to do an exchange. So proceeds come into us as the qualified intermediary. That's what officially starts, the timeline that we're going to be talking about for the exchange. And we're also going to talk a little bit about how the funds are held in a qualified account in order for the taxpayer to avoid being in constructive receipt of funds. So the account is qualified if the taxpayer's rights to receive, pledge, borrow, or otherwise obtain the benefits of the cash are limited to the Treasury regulations under the G6 restrictions. So it's usually the second conversation that we get into this conversation with clients about, because they may or may not have done an exchange before. They're thinking about selling, thinking about exchanging. And then once, we start preparing our documents, we're talking to them about understanding that there are only certain periods of time that you can receive your cash. So that 45-day calendar days to identify property is kind of an open window where you can identify property. If you revoke your identification on day 45, we can release your funds on day 46, and you'd be subject to the normal capital gains tax that you would have paid had you not done an exchange. So that's really an open window period of identification for clients to still kind of determine if they're going to be able to move forward with doing an exchange. Did you want to
So,
talk about the other two,
yes.
Mary?
Yeah, of course. And people ask us why we have to have these limitations on their rights to receive the cash. And it goes back to this idea that we're trying to structure the transaction as an exchange. And so the regs have these very stringent requirements over when the cash can actually be released. So Teresa said within the 45 days, if you don't identify replacement property on day 46, then the restrictions are released and the cash can be paid back. If it's the end of the exchange period on day 180, day 181 actually, and there are proceeds that have not been expended on replacement property, the restrictions are lifted and the cash can be released. The tricky one is the third one that says after the taxpayer has received all of the identified replacement property to which it is entitled, if there is cash remaining in the qualified account, it can then be released. And so what does that mean? Teresa sells one. Oh, excuse me. Go ahead.
No, go ahead.
Okay, so if Teresa sells one property and identifies two potential replacement properties and closes on one of them on day 90 and doesn't spend all of her proceeds, and on day 91 decides she's not going to buy that second property, she still has the ability to. She still has the possibility of closing on that second identified property. And if she wants her cash back on day 91, we're going to have to tell her no, she's got to wait until day 181. So it's actually a very important conversation that we like to have with people at the time they're identifying their property, so that we don't get into a situation where they're sort of finished with the exchange, but they have cash remaining and they want their cash back for other purposes, and we have to tell them no.
Yeah, there's nothing worse, especially if they found another piece of property that they want to buy and they didn't identify it, and the money is being held until day 181. So it's really important for them to understand. It's usually a second conversation in, because they're a little, a lot of moving pieces and parts are always going on with our clients that are exchanging. So the identification notice must be a written document that is signed by the taxpayer and hand delivered, mailed, telecopied, emailed, faxed, otherwise sent before the end of the identification period, which is midnight on the 45th calendar day.
There are a couple of ways. Yeah. Well, I mean, clarify that just real quickly. Sometimes there are extensions. If there is a federally declared disaster, for example, when there are the wildfires in California, often the IRS will issue a notice that will extend the time period for investors involved in like-kind exchanges for up to 120 days for both the 45 and 180. But so it does happen, but generally correct. No extensions. You don't get to carry over to the next business day if day 45 falls on a weekend, for example. You have to do the identification on that weekend or the earlier business day. There are a couple of options for identifying replacement property. The first is the 3-property rule, which says within the 45-day window, the taxpayer can identify up to 3 potential replacement properties of any fair market value. So if you sell a $1 million property and your client wants to identify 3 properties, each worth $5 million, that's fine. The second option is the 200% rule, which is a limiter, and it basically says if you identify more than 3 properties, then the combined fair market value of everything identified can't exceed 2 times the value of the relinquished property. So where we're selling our $1 million property, if we want to identify 5 potential replacement properties, each worth $1 million, we're over the 200%. So we can't do that. They can't exceed $2 million in that example. The 95% rule is really an exception, and what it says is that if you violate the 3-property rule and the 200% rule, as long as you acquire at least 95% of the properties you've identified, then your ID will still be valid. So in my example where we're selling for $1 million, we're identifying 5 properties, each worth $1 million. Okay, we're outside the 3-property rule, we're in excess of the 200% rule. As long as we acquire at least 95% of the identified properties, the ID will still be valid. We don't see that used very often, only I think when a taxpayer is acquiring maybe a much larger portfolio of properties and they have a very high degree of certainty of closing on them. So the regs also tell us exactly how to identify property. So you can identify property by street address, city, and state. Make sure you include the state. Sometimes people forget to do that. You can identify property using a distinguishable name. So the Empire State Building is pretty distinguishable, but it probably wouldn't hurt to include the street address and the city and state there as well. And then finally, the property, when it's described, has to be unambiguously described. So if we look at the northeast corner of Hollywood and Vine Streets in Hollywood, California, the question here is, can you actually pinpoint the parcel or the improvements at that exact location? Maybe you want to attach a legal description or a plat map. You want to talk about Dobrich?
Sure, can mention
One
it
of
for
your
a moment.
favorites.
So yeah, it's the 45-day identification window, 45 calendar days to identify. This was a case that was out there, it was a California case. Taxpayer, husband and wife sold investment property in California. I think it was in Antioch, California. They acquired 3 replacement properties that were not identified to their qualified intermediary. The transaction preceded the issuance of the Treasury regulations and the formal guidance of the identification requirements. The taxpayer had claimed that he identified the properties verbally to his wife. And at trial, it was revealed that Mr. Dobrich asked his real estate broker to backdate offers on the replacement properties so that they fell within the 45-day window. And then none of the properties were listed for sale during the 45-day window. The tax court found clear and convincing evidence of intent to commit criminal tax fraud. So if clients don't identify to us as their qualified intermediary, we're going to be, releasing those funds on day 46. We have to report to the California Franchise Tax Board by certain dates. There's just no, no real way around this. We're not going to be jeopardizing our business or our client's business by not adhering to the IRS rules when it comes to identifying property. So acquisition of the replacement property. Did you want to say something, Mary? Or
Nope.
Okay. So winding out the forward exchange mechanics. We prepare the documents. The funds come into the exchange. 180 calendar days to close on the property. You have to identify the property within 45 calendar days. So when they go to acquire their replacement property, we're going to prepare a set of documents working with their closing agent on the purchase side. So there's the deed that's transferred from the seller to the taxpayer. Contract comes into us with written notice, and the proceeds are then going to go to closing for them to acquire their purchase property. So we're working with clients on both sides of the transaction until it's completed. And that's kind of the standard forward exchange mechanics. So what we're going to talk about now is we have some slides on taxable boot, talk a little bit about how entities are held. What the IRS requires is the same tax reporting entity that's selling be the same tax reporting entity that's buying. And then we'll spend some time talking about reverse exchanges. So now we're going to dive into boot. Exciting stuff. Are you ready, Mary?
Boot, I am so ready. So boot is non-like-kind property that your client may receive in the exchange that causes them to have to pay some tax or recognize some gain. It might be a promissory note, it might be cash, it might be relief of debt, which we call mortgage boot. And there are a couple of rules that if you just keep them in mind, actually 2 very simple rules. If you keep these in mind, you'll always avoid having any boot. First is make sure that your client acquires replacement property of at least equal value to the relinquished property that's given up. And make sure they spend all of their equity on buying the replacement property. So if you do those 2 things, you won't have to worry about boot at all. But there are some very specific rules in the regs that tell us how you can sort of net boot between your sale and your purchase, in between cash and debt. So we have a couple of very simple examples. We're assuming here we're selling property for 100, where the property is unencumbered. I will say we're ignoring selling expenses for these examples, but selling expenses can reduce cash boot in the exchange. So that's something you want to keep in mind. So if we sell for 100, we have no debt, we get equity of 100, we buy replacement property also for 100 and spend all of our equity. The cash we paid offsets the cash we received, and we've met our 2 rules. We've bought property of equal value, and we've spent all of our equity, so there's no boot. The next example, we are selling property that is encumbered by a mortgage, and when we get that mortgage paid off, that relief of debt, if we don't offset it with either new cash or new debt on the replacement property, it's going to be like income to us. So we sell for 100, we have our debt payoff of 50, we have net equity of 50. We buy property for 100, so we bought property of equal value. We're spending all of our equity of 50 and putting fresh cash into the purchase, additional $50 of cash into that purchase. That cash paid in to buy the property offsets the debt relief from the disposition of our old property. So there's no boot here. In this example, we are just matching up our debt and equity on both sides of the transaction. So we're selling for 100, we have debt relief of 50, we have equity of 50. We're buying property of equal value, $100, and we are putting new financing on our replacement property in the amount of $50 and spending all of our equity again. So the debt that we put on the replacement property offsets the debt we were relieved of on the sale of the relinquished property. This one's going to cause us to have little boots, some taxable exposure here. So we're selling for 100. We have that debt relief of 50. We have equity of 50. When we go to buy our replacement property, our lender is willing to give us a 70% LTV. And so why not, right? Put that debt on that property. The net result is we only have to spend $30 of our equity. So there's excess cash that's coming out of the exchange. So we only met one of our rules here. We bought property of equal value. We did not spend all of our equity. So we're going to have cash boot in this transaction. One way to kind of cure this maybe or fix it, if you can, is to ask your lender to reduce the amount of loan, the principal amount of the loan, give you the opportunity to draw down on a line of credit later to take some cash out. But if you are in this situation, there's going to be excess cash. You could also buy additional replacement property. Go ahead, Teresa.
Yeah. So dealing with excess debt and unspent equity. So once you complete the exchange as a separate transaction, you could refinance or pull out cash, and then you would not necessarily have any taxable boots. So how long should you wait before you do a refinance? Some people say a day after you complete the exchange, maybe wait a couple months. My theory is always by the time people get done with the exchange transaction, they're ready to take a breath anyway. So, but there should be some sort of time there. So you definitely don't want to overfund your loan and walk away with cash, but you can certainly, as a separate transaction after you complete the exchange, refinance and pull some cash out. So one of the main requirements with 1031 that we talk to clients about on a daily basis is what the IRS requires is the same tax reporting entity be the same tax reporting entity to acquire new property. So if if Mary and I own property in a trust and we're going to sell property, then we need to acquire property together. If we own property in an LLC, we need to acquire property together. If we're tenants in common, we can acquire property separately. So what we see a lot of times is you have business owners or perhaps family members that aren't always getting along, and they have big ideas about when they sell what they're going to do with their proceeds. Some of them are going to pay the tax, some of them are going to cash out, pay the tax and cash out, or they're going to exchange separate from one another. Some of them may want to buy together. So, here's what we're going to be talking about. What do you do when partners want to separate? There's some options.
Yeah. So the drop and swap is probably the most common scenario that you've probably all heard of. And the idea here is that you terminate the partnership prior to closing on the sale of the relinquished property, deed the property out to the now co-tenants, and then let them hold on to that property for some period of time before they sell or exchange their interests. And so the question really here is how long after they've taken the property out of the partnership do they have to wait before they can sell that relinquished property? I think we have a picture on the next slide. Mm-hmm. There it is. Okay. So there we have our two A, B, and C. B and C want to do an exchange on their own, and A is taking their cash. If we do this drop a day before closing and we get audited either by the IRS or by the California Franchise Tax Board, it is likely to be disqualified. And the reason is that the IRS in particular does not believe that the holding period from the partnership tax to the individual co-tenants when they take the property out of the partnership. There's a couple of cases out there, Teresa, on the next slide, I think. So the Chase case is a pretty classic idea of how not to do it. Chase was a partner in a partnership that owned real estate. He wanted to do a like-kind exchange. The rest of the partners didn't. He took a deed from the partnership and never recorded it. And from the time that he took the deed to the time that they sold and he attempted to do his exchange, they still operated the property like it was owned solely by the partnership. So the partnership, all the income and expenses were paid out of the partnership account. It didn't really look like he owned anything other than his interest in the partnership. And that was what the tax court concluded, that he exchanged his interest in the partnership and not his interest in the underlying property. These two revenue rulings from the 1970s are still on the books, and they say what I just mentioned a minute ago, that the IRS will not allow you to consider that you held the property for investment in a non-recognition transaction. So when you take the property out of the partnership and deed it to the co-tenants, basically your holding period for 1031 purposes sort of starts over. There is some good case law out there in the Ninth Circuit where taxpayers have successfully argued that they were just exchanging the same underlying investment and that they had held the property for investment. The swap and drop is another option you can think about. If the partners can stay together and do the exchange in the name of the partnership, they could sell the relinquished property to their buyer, buy maybe multiple replacement properties, and then wait some period of time before they break up the partnership and distribute the properties out to the various partners. I actually had a transaction that was very similar to this about a year and a half ago. It was just a two-person partnership. These guys had sold some property, some farmland here in Illinois, and they wanted to go in different geographic directions. One was going out to Arizona and the other was going to Florida. So they ended up buying 4 replacement properties before the end of 2020. And their plan was to, in 2021, terminate the partnership and deed the properties out to the individual partners. So that's the swap and drop. Same issue here, though, is how long after we've acquired that replacement property is it advisable to break up the partnership and contribute the properties out? So you want to wait a little bit of time if you can. Hopefully across the tax year.
Mm-hmm.
Yep. Again, there is some good case law out there. The Maloney case, taxpayer acquired property in a corporate entity and then immediately liquidated the corporation after buying replacement property. They argued successfully that it was the same underlying investment. So I think you're taking your chances, though, in California in particular. I know the FTB is very aggressively looking at maybe not so much swap and drop, but definitely the drop and swap.
Comes up pretty much on every other transaction.
Yes.
People can go back and revisit their, with their partners and decide what they want to do with their advisors. There's also the partial installment sale. So at the relinquished property closing, ABC LLC takes a note from the purchaser payable to the partnership. So in redemption of C's interest, the partnership endorses the note to C. So then the partnership can acquire the replacement property without C. So I think those conversations that folks have with their advisors, we steer them back to their advisors. And when people are thinking about selling, it's a good idea to always be thinking about, what's the plan going forward? Are you going to be selling? Are you going to be, paying the tax, and who's going to be doing what? So reverse exchanges, a parking arrangement revenue procedure came out in 2000-37. So it's a safe harbor for parking arrangements. So the IRS will not challenge the qualification of relinquished property or replacement property in certain reverse exchanges. And there's a lot of benefits of doing reverse exchanges. You can be an opportunistic buyer. You're out in the marketplace. You can start looking around for the property that you want to acquire. You haven't lost any of your cash flow yet. The clock's not ticking for that 45-day window yet. You can move your business to a new location without interruption of your existing business. You can construct improvements or rehab the replacement property during the parked period. So as I mentioned, our role is the exchange accommodation title holder. We can acquire the relinquished property, or we can acquire the replacement property. Typically, we always acquire the replacement property. And then all parties must treat the exchange accommodation title holder as a beneficial owner of the park property for federal income tax purposes. So it's definitely a much more advanced transactions. We like our clients to have an attorney that is working with them.
Can I just say something on that? The reverse has become a lot more common because, as we were talking about just before we started, Teresa, the market is crazy. And people are really anxious to get their replacement property under contract and ready to go before they even put their relinquished properties on the market for sale. So if you are in the situation, your client's in a situation like that, where they really have to close on the replacement property first, it's not uncommon, especially now. And the parking arrangement is a really good solution. It is, as you said, it's more complicated, it's more expensive, it's a different sort of profile of transaction, but it's also very powerful.
The timeline is the same. You still have to identify the property that you plan on selling within the 45-day window and close on that sale property, the property that you're selling, by day 180. But if you don't end up selling your existing property, you don't have any capital gains tax, you just have a higher cost of acquisition for the property that you just parked in the exchange.
So the RevProc allows for a number of non-arm's length arrangements to run between the EAT and the taxpayer while the EAT holds the property. The RevProc says the EAT can also be the QI, but we separate those functions just for liability purposes. If your client has to get financing to make the purchase of the replacement property occur, your client can separately guarantee that financing so that the lender knows their ultimate borrower is your client. And the taxpayer can also loan funds directly to the EAT, and that loan does not have to bear any interest. While the EAT holds the property, we're going to put a net lease in place or a management agreement, whichever is easier and appropriate for the property. The net lease does not have to bear any rent, so we're just really basically just turning over control and operation of the property to the taxpayer during this period of time so they can actually deal directly with the tenants and manage, operate the property. If your client wants to make improvements to their replacement property, they can be the construction manager. While we own legal title to the property, they can actually get on the property, do whatever they want to, increase the value of the property, maximize their tax deferral. And then also we are allowed to have a put and call in our accommodation agreement so that, unlike in the forward exchange where we talked about how the cash might get tied up, in the parking arrangement, if we park property today for an investor and they decide next week that they're not going to sell the relinquished property, or for whatever reason they just want to take the property, the parked property, back from us, they can call it right back from us. We can also adjust our promissory notes and agree to certain types of formula pricing. For example, if we park property for 100 and we increase it in value by 15, so at the end of the transaction, we're transferring the property back to the taxpayer at its increased value. This is what it looks like. Our third-party seller transfers legal title to the EAT. Typically, the EAT will create a brand new special purpose LLC to be the title holder. Then we will sign any loan documents, any security instruments that the lender typically requires. Again, taxpayer can guarantee that financing. And we put a net lease in place so that we're turning everything over to the taxpayer, except for legal title. Teresa mentioned you have to make sure you identify your relinquished property within 45 days. If you know what you're selling, your client knows what they're selling, there's no harm in identifying that relinquished property right up front, because the same timelines apply. You have to make sure it's done within the 45-day window.
We're usually talking to them about the values too, to make sure, because sometimes clients need to do a, they'll start out as a reverse, and they'll park the property with us. And then their relinquished property that they're selling can be substantially more than the property they just parked. And so we'll talk a little bit about what happens to those proceeds when we go through our slides here. So sale of the relinquished property, the title to the relinquished property goes to the purchaser, the proceeds come into the qualified intermediary, and then the assignment of the contract to the notice of the purchaser. So transferring out the replacement property from the EAT to close out the exchange, there's the assignment of the contract that goes to the qualified intermediary, payment of the purchase price to the exchange accommodation title holder. So, there's taxpayer assigns its rights under the contract for purchase of the replacement property to us as the qualified intermediary, because we were the exchange accommodation title holder. Now they're transferring their rights for us to be the actual qualified intermediary. Then the taxpayer instructs us as a qualified intermediary to either pay the purchase price to the EAT as seller of the replacement property. And then the EAT uses the proceeds from the relinquished property sale to pay down or pay off the debt. So some clients may have cash out of pocket for the acquisition. They may have a combination of cash and a loan, or it may be 100% lender financing. So, there'll be instruction on if we're going to pay down that loan or pay back the taxpayer who upfronted the cash. And then the EAT transfers the replacement property to the taxpayer by the assignment of the LLC interest.
Yeah, one point on the lender here, you want to make sure if you're dealing with like Fannie Mae or Freddie Mac, sometimes they require 30 days or 60 days notice before we're transferring that property or assigning the LLC interest. You want to make sure you have enough time to do that. Also, if you do have lender financing, want to be aware in case there is a prepayment penalty. So you don't want your lender to be surprised, and you don't want to be stuck paying a big prepayment penalty if there's a lot of cash coming out of the relinquished property sale and you're paying down that lender who's not expecting it.
And so then if there's leftover cash, because you're actually selling relinquished property and we're becoming the QI, that starts a timeline for a forward exchange. So then the client can identify additional replacement property to be able to defer the remaining part of that boot that comes from the sale of that relinquished property. So it becomes a parking and then a forward exchange. And then sometimes it can be an improvement exchange. So we specialize in forward exchanges, reverse exchanges, build to suit, improvement exchanges. So if a client, for an example, I don't think we have a slide on this, but say a client sells property for $2 million and the $2 million cash comes into the exchange and they want to do improvements on a new property and we're the qualified intermediary. They can say, for example, take $1 million of that cash and acquire property, and they have us as the exchange accommodation title holder acquire that new property for them. We park it in the exchange, and then that's where they can use the remaining $1 million to do improvements utilizing the full 180 days from the time that they sold their existing property. So lots of conversations to have with clients when they're thinking about selling and buying and investing and what the mechanics look like. So we can open it up for questions. We can talk about partnership exchanges, drop and swap, held for investment requirement, construction improvements, related parties. There's always a 2-year holding period with related parties. The IRS doesn't want to see one of the related parties walk away with cash at the end of the day. So you got to be careful when you're exchanging with parents, children, siblings. Vacation homes, personal use property, split treatment exchanges, seller carryback notes come into play sometimes if someone's unable to get financing and the actual seller wants to, give them a seller carryback note. How does that affect their exchange? Closing costs, lender fees, earnest money deposits. So thank you, and we're happy to take any questions.
There are not any questions in the chat yet.
I don't see any questions in chat. Does anybody have anything? Randy, did you have any questions?
I didn't know. Yeah, thank you for your time. I guess we're gonna wrap up. I thought I'll put another plug for another program. We have June 17th. That one will be focused on the new Uniform Partition and Air Act, whereas the April program will be more a broader program on co-ownership and disputes and civil, family, and probate court with real estate. But I'd like to thank our speakers again, and I don't see any other questions other than a thank you in the chat.
Thanks for having us.
Yes,
okay,
thanks
well,
for having us.
Thank you both very much. And thank you, Randy. And, do check the calendar for the real estate programs. There is one on April 28th and not one in May, but there is one on June 17th. So all the details will be there, and registration for those programs should be available within the next couple of weeks. So thank you all. Oh, we got somebody in the Q&A. What do we got?
Got it.
What's an example of buying out interests of siblings in an inheritance?
So let's say the siblings inherit some property. Oh, I haven't moved, so my lights went off in my office. Siblings inherit some property from their parents, and they own the property as co-tenants. You could, if one of the siblings wants to sell their interest to the other sibling, that's okay. They may not have a lot of gain if they have stepped up basis in that property, that inherited property, or maybe they do. But if you do sell or buy from a related party, what 1031F says is there's a mandatory 2-year holding period. So if one sibling sells to the other and does an exchange, the one who is selling has to hold their replacement property for 2 years, and the buyer sibling of the relinquished property has to hold that relinquished property for 2 years. And it's incumbent on the seller exchanger to file the IRS Form 8824 for 2 years, because they have to check a box saying it was a related party exchange. I hope that answers the question.
Okay. Last chance. I feel like an auctioneer.
Yeah.
Going once, going twice. Okay, good
All right.
afternoon. You're all released to the beautiful day.
Thank
Thank
you.
you.
Thanks, Mike.
Yeah.
Okay, bye, Randy. Thank you,
Take
Teresa
care.
and Mary.
Thank
Bye-bye.
you.
Oh, Mary, Teresa, make sure you send me the.
The slide deck?
Oh, yeah.
I'll send it to you right now.
Oh,
Thank you.
and Teresa, if you do find out about the Bishop Ranch, I still think that'd be good to know, because, you know, we maybe Ann will end up rotating, you know. We could always try that too, different venues.
Okay.
Oh, right.
Yeah, we did a lot of presentations at Scott's. I mean, tons over in Oakland and in Walnut Creek. And it's just so sad that they're, you know, and specialties went out of business, I heard, and that we bought lunch for them all the time for seminars. And
It's tough out there. Okay.
Yeah.
Thank you very much,
Okay,
everybody.
thank you.
Goodbye.
Fair.